We have a very important video today. I think that all investors need to understand, and I'm going to share that today. So feel free to share it with others at the end of this video if you feel anybody could benefit from this. We're going to be talking about the dangers of over diversification. There is such a thing, and we're going to cover it. And I myself always preach to diversify portfolios, as do many others on YouTube, but I don't think there's enough context given to it because there's a point where it's not beneficial. And so we're going to cover that. And so also please subscribe to my channel. I appreciate all the viewers, and I give a different opinion, a different portfolio for people to look at and follow and see my strategies. So I think it's a good thing to get others' perspective, especially when you're investing. So be sure to subscribe. So diversification. First of all, diversification is a great thing. It provides protection for your portfolio. It helps reduce the risk of losses, basically. And I like to think of it as insurance. A healthy diversified portfolio just is protection, as simple as that. And especially when you diversify across various asset classes that have low correlation, so aren't related, that's important to do. The balance is, with diversification, is minimizing the risk while maximizing the returns. It's as simple as that. But that balance is the hard part for people to do. I've seen, people think they're diversified because they have 15 different companies within one industry. But if that industry crashes and takes a long time to recover, you're going to wish you were diversified across different sectors and industries, not just in one industry. So I've seen people put all their money in, the airlines industry and buy 15 different stocks, and we've seen what happened with the pandemic. The airlines industry got crushed. So it's really something that you really have to look at your portfolio and do some, create some charts or make sure you see where you're heavily weighted. There's also people I know that put all their money into one company. They really are bullish on a company. I've seen it happen with Peloton. And we all know that Peloton has crashed over 70%. That company is now at the point where they need somebody else to buy them out because they really don't have a future where they're at. And so that is just extremely high risk, but I've seen people do it, and that's where diversification comes in and helps out. It's providing protection. It's helping to reduce, the risk of losses. But there's a point where it goes from being beneficial to dangerous, and that's what we're going to talk about. So if we kind of talk about over diversification, so many investors have the wrong assumption that more diversification means reduced risk and better performance. And that's where many people just over diversify. I've seen portfolio with hundreds of stocks. First of all, who has time to research hundreds of companies? You might as well just put your money into an ETF. But there's so many negative consequences to being over diversified. And that's where people need to really understand this, because we invest for a reason, right? It's to make money. It's to become wealthy. And when you're over diversified, you're really reducing that potential of growing your money. So over diversification occurs when the diversification does not reduce the risk more than the loss of the potential returns. So in other words, you lose potential returns with insignificant risk reduction. The point of diversifying is to minimize the risk by trading off potential returns. There's no point in diversifying when your returns are lesser, yet your overall risk stays the same. So to put this in kind of something visual, let's look at this chart here. We see in this chart that on the very left, if you put your money into one stock, your risk is at the highest point. And each stock that you buy into your portfolio or put into your portfolio after that, your risk is reduced significantly. But there is a point where it shows here at when you buy about 20 stocks, any stocks you buy after that really aren't reducing your risk in a significant way. It's very small reduction of risk. So there's a point where when you add a certain number of stocks, you're at a healthy balance, but if you add more after that, it's really making no difference in reducing your risk. And I've read that the optimized amount of stocks to have in your portfolio is between 15 to 30. This chart shows here 20 is the magic number. But everyone has to be comfortable with what they're comfortable with. But I'd say between 15 and 30 is healthy. Anything over that, you're really not reducing your risk significantly anymore, but you are hurting your potential returns. So the most common misconception investors have is that risk is proportionately reduced with each different stock or financial product added to a portfolio. It's entirely false. You can only reduce risk to a certain point at which there is more significant risk reduction, at which there is no more significant risk reduction or benefits from diversification. So there's a point where diversification just doesn't become beneficial anymore. So the more you diversify, the more potential returns you lose. That's what I want you guys to understand. The more you diversify, the more potential returns you lose. And we can see this in an example that I kind of made up. If you have somebody that bought 10 stocks and they put $10,000 into each, so they had $100,000 to invest. So 10 stocks, $10,000 into each stock, and you have one of those stocks that really has an awesome year. We're talking about, or even maybe 2 years. This stock just, you really believed in it, you did your research, it's a quality company, and it really takes off and it grows 100%. In that one stock, you will make $10,000 in gains. But if you're like somebody that buys, let's say, 100 stocks in their portfolio, putting $1,000 into each stock, and that one stock really does well, your gain is only $1,000. So from 10 to 1,000, you're missing out on a potential extra $9,000 in gains because you're spread out way too thin, and the effect of a stock doing well is reduced. And so that's what I want you guys to understand is a lot of people on YouTube just don't give context to this. They scream out there, diversify, 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 and that's leading people to buy too many stocks. First of all, like I said, it's too much to manage. You can't possibly look at 100 different earnings reports and dig into each company, consistently. That'd be a full-time job. Also, it reduces your risk of growth, as we have shown in these examples and talked about. So to provide, the perfect situation, like I said, when you have low correlation between your assets, that's the best. And make sure it's in different sectors, different industries, and make sure that you do your research on them. That's going to provide you the best portfolio with the best potential returns. But like I said, I think people, they get very excited and they start buying this stock and this stock and this stock, but then they're spread way too thin. They only have a couple $100s in each stock or a couple thousand, and if one takes off, it really doesn't move the needle up on your overall growth compared to if you had 15 to 30 solid companies that you really believed in. If one of them takes off, or a few, you're going to make higher gains than a 100 or 200 stock portfolio. It's just as simple as that. So I want to show you kind of my portfolio, and let's see how I'm doing with diversification. So if we look at my sector allocation, first of all, let's say this. I have 16 individual stocks, so I'm right in that range between 15 and 30. I also have 9 ETFs. I just like to have ETFs for those areas I'm not too knowledgeable on or feel they'll benefit me. So altogether, I have 25 holdings. It's my goal to make my individual stocks 75% of my portfolio and my ETFs 25%. I think that's going to provide me a good level of protection, but also a good level of growth potential. So if we look at this chart here, my ETFs and stocks are all bundled into whatever industry or category they're in. So we see I'm very heavy in technology. So I need to really work on reducing that. And then real estate and healthcare are my next two biggest. Energy was a tough one when the pandemic hit, so that's why I think I'm really low in that area. But overall, I'm in different sectors. One thing I like to do is I buy an ETF for each sector. I don't have one in the technology because I feel like I have more companies in that sector or industry than I do in the others, but I like to have an ETF for each sector of the market. as well as I have one for international, and then I have my SCHD, which I love as a dividend play. But as I mentioned, I don't have much money in the ETFs. It's more for adding a little bit more diversification and protection, but I only want my ETFs to make up 25% of my portfolio and my stock 75 like I mentioned. So one of the things I did before I made this video is I opened up each ETF that's in each industry that I own, the ETFs. What I really liked is that I had a stock in the top 10 of each of those ETFs, an individual stock that I purchased outside the ETF. I didn't do this on purpose. I didn't look at these ETFs and say, I want to buy one of these in the top 10. I did my own research, and it so happened these ETFs also have them in their top 10. Either it's the number one, so my healthcare ETF is in their top 10, the number one is J&J. I have J&J. In industrials, 3M is the 10th stock of their top 10. I have 3M. So it was really nice to see that, my research into these companies I feel has paid off because these ETFs also agree, which even if it didn't, doesn't matter. It's my perspective on it, but it's just good to see. So I think I'm a little weighted in some areas too heavily, so I need to work on balancing it out. But I think I have a low correlation between these stocks when I looked at them, right? I have like Coca-Cola, 3M, Microsoft, Vici. I could go on and on. They have very little to no relation between each other, which is great. And that protects my portfolio and why I think I've done good. You've seen some videos in the past where I reveal my performance. I have gone down because of the market now by quite a bit, but I'd say I'm at like 13% growth in my portfolio. I was at 23 at the height, but everyone's portfolio is down now with this, we'll say market, these dips that we're having. If we look at the gains and loss in each sector, you'll see where this pays off. Financials have done excellent. Healthcare has, and my SCHD dividend equity ETF has, but you'll see like telecommunications, consumer staples are a little bit in the loss for me. But overall, the protection I have is great. Imagine if I was only in consumer staples, in the companies that I chose, man, my whole portfolio would be at a loss. These other sectors, the way I'm diversifying, and I think the way I only have 16 individual stocks, and my stocks are the ones that I put most of the money into and not my ETFs, really help save my portfolio and gives me that potential for future growth. I'm only 2 years into this, investing in this portfolio, and as I continue to invest into them, I think in 5 to 10 years, it's going to pay off in a big way. So overall, this video is to really highlight and give context to what diversification really means. What's the difference between being, investing in one stock and having that high risk to investing in 100 stocks and providing yourself really no opportunity for good growth. There's that healthy medium, about 15 to 30 stocks. You have to do your research because you could pick 15 to 30 total duds, right? A lot of people were into the whole meme investing, small cap investing, these companies that really don't have that quality. But if you make sure you're investing into good, solid, quality companies, maybe allocating 5% of your portfolio to maybe a more riskier choice of a company. My risk I'm taking is on Tattooed Chef. That's a small company, they're growing, they really don't have that history yet, but I do like that company and all the research I've done. But that's my one stock that I'm like, okay, it's a newer company, I'm gonna put some money and take a risk on it. It's a low percentage of my portfolio, where my big dogs are like Microsoft, I really like J&J, I have, into Vici, I have a lot of money, things like that. So diversification is really a balance. So you have to look at your portfolio. If you have 100 stocks, you should really start looking at how you can trim that and bring it down significantly, because you're really going to hurt yourself in the end, because if one stock takes off, you're really not going to benefit off it like you could if you had just 15 to 30 stocks. So this is the video that I was really excited about putting out, because I think it's really important for people to know this and understand it. Do your own research on it, but I did my research and putting it out here for you guys for free. So Let me know what you think. Let me know how many stocks you hold in your portfolio. As mentioned, I hold 16 individual stocks and 9 ETFs. I have 25, holdings total. So I think I am in that healthy, optimized range. And so I need to make a few adjustments, right? My technology sector's got way too much money into it compared to the other sectors and industries. But yeah, let me know if you feel like you're under diversified or over diversified and what you plan on doing about it. For me, it's more about continuing to balance my portfolio in a healthier way, not being so heavy in the tech sector. But yeah, I think this is important. Please share with others. I think it's very important for others to know this too, because it's very easy to just hear all the YouTubers say diversify, and I think that just pushes people to buy more and more stocks instead of do it in the healthy way in the context we provided in this video. So that's all for today. Have a great day. We'll see you next time on Mark's Finance and Fitness.